Welcome back. Our next guest says we are heading into a period of lower market trading that could increase volatility. We're joined by Sam LaBell, portfolio manager at Veritas Asset Management. Thanks for coming in, Sam.
Thanks for having me.
I think you're referring to the proverbial sell in May and go away period, correct? As we approach the summer months, correct? Now, what does that mean at a time of so much macro uncertainty?
Well, obviously, we're very headline driven. I'm away from my desk right now, and I'm pretty sure I'm missing some tweet from someone in the administration. So just the fact that that has brought a lot of volatility, if we enter the period, the normal summer period, where you have less trading volume, generally people go to the cottage or the like. Even the portfolio managers tend to go to cottages sometimes in the summer. And that means a little bit less trading volume. So you may see this volatility that we've experienced. We would expect it to be sustained through the summer because you have fewer traders pushing the market in larger ways.
What sectors do you like in the market right now?
Well, no surprise that I also agree with the gold thesis. I think there's we run a very simple model to explain year-over-year gold prices, and they are trade-weighted U.S. dollar, S&P 500 returns, and the direction of interest rates on the 10-year yield. And effectively, all of those three things we think are favorable to gold right now. We're going to have weak equity returns. We're likely to see some decline later in the year if the Fed does end up cutting rates. And the trade-weighted U.S. dollar has been depreciating as people sell some equities and move into global assets. So all those things help gold. We think that there's some limits. I'm not sure that 5,100 is the right price. We did an analysis taking a look at how gold has moved relative to the value of the U.S. economy. That's kind of our numeraire. And it doubled roughly after the 2008 great financial crisis, global financial crisis. And we're moving to almost doubling here. So there is some limit here where beyond which you'd need some kind of monetary crisis to really force gold a lot higher. And companies are making very good money. We prefer to focus on the demand side. The supply side is relatively predictable. The demand side has really been driven by consistent central bank buying. So they're buying the same volumes of gold, but at higher and higher prices. And part of that is to diversify away from the U.S. dollar. So that's been very sustained, and central banks are saying they're going to continue doing that. On the investment side, it tends to be very pro-cyclical. People move into gold ETFs, and that creates even more demand. So it tends to accentuate the move. And right now we are seeing interest in ETFs and flows into ETFs. That's a tailwind for gold. But it can reverse as well, and that can be quickly a headwind for gold. So we're a little bit cautious.
I think I hear you saying that the bull market in gold is maturing, but is not over yet. And
yes.
You know, a lot of our viewers would look at the gold price graph and say, yikes, if I buy now, I might be buying at the peak. You think that there's more to come and that an investor could buy, let's say, a gold bullion ETF, an ETF that gives them exposure to the metal. And that would be the right call at this point.
Yes, and then our approach is also to take a look at stock picking as well. The producers are in the sweet part of the cycle where they've got their development projects now up and running. They're starting to build volumes, and their cash flows are going through the roof. So they're deleveraging, and Newmont's a great example, just reported and had record first quarter cash flow. They're going to take that cash flow. They've already paid down debt. They've already high-graded their assets by selling off assets. So where does the cash go? Back into share buybacks. So it's a very favorable setup for the producers, but you want to pick the producers that have low operating risk, low geographic risk, and our favorites there are Newmont, Agnico Eagle, and we do own some Wheaton Precious Metals to get access to the streaming aspect of it.
How important is the streaming side? Do you recommend investors get exposure to streaming as well?
So the advantage of streaming is you're taking the royalty off the top line, so you don't have as much exposure to costs, but you do have exposure to outages at mines. So there's still an operational risk element, but in terms of that leverage of leveraging your operating costs down, you don't really have that, but obviously it's a little bit lower risk, and they're able to diversify quite a bit more across many more projects.
What sectors of the stock market are you avoiding right now?
So we did take down our weights in industrials and cyclicals earlier in the year. Air Canada, for example, we'll see when they release their earnings, but they've said that there's been a redirection of travel away from the U.S. They're picking up some travel to Europe, but we're not sure that it's going to 100% compensate for that weakness. So we'll see what they say, but we think that there's going to be some pressure here on business spending, on consumer spending. We still don't know where tariffs are going to settle. So cyclicals, TFI, for example, we sold early in Q1. And so these are companies that are struggling through a little bit of uncertainty.
The Canadian banks, are they a safe haven, or are they exposed to an economy facing big headwinds?
So this is a careful what you wish for situation. They are well priced. They're at their 5-year averages in terms of PE. TD is discounted on the whole U.S. money laundering issues. So we do like Royal, we do like TD. We think that if you have exposure on both sides of the border, that's good. If you have exposure to capital markets and trading, we saw that with U.S. bank earnings, that's good. And we're watching for signs of bookings in terms of provisions for credit losses. So we are cautious. Obviously, the Canadian housing market softened a little bit here. Prices down a couple % year over year. But it hasn't collapsed, and the employment picture is still good. And we would expect, whichever government forms the government after the election, that there will be some fiscal stimulus coming in Canada to help some of the sectors that are affected by tariffs.
You mentioned TFI that's a trucking company, obviously, that does business all over North America. You reduced your weighting there. What do you think of the rails, the rails, which are also involved in shipping and also do a lot of shipping across the border?
So we did fully exit TFI. TFI has exposure to less than truckload, so it's quite a different picture in terms of the competitiveness of the market and who you're competing with. Rails have an advantage that they ship commodities, and commodities are still going to be shipped over borders. So their volumes are holding up quite nicely, but we own some CP, we own some CNR. We believe that they're good at controlling their costs, and they'll probably earn through this. Trucking is a little bit more cyclical, and obviously the operating ratio at TFI really was blasted in their first quarter, and they've had a very weak, their fourth quarter, and their recent quarter is also weak. So we're a little bit hesitant on trucking.
What is your view on the auto parts makers, which are very much in focus, very exposed to headlines, and now you mentioned tweets from the White House?
Yeah. So yesterday we had a tweet that said that maybe we would let all of the Chinese parts in tariff-free, and somebody in the administration was quoted from Financial Times. And then we had a press conference after hours by Mr. Trump, President Trump, saying, no, I'm not going to take any tariffs off anything. So we really don't know the situation. We do know that the current status quo is effectively that they want to tax any non-U.S. content in the vehicle. We also know that there's steel and aluminum tariffs. They're going to drive up the price of vehicles. I would say the consumers are very price sensitive on vehicles. If vehicle prices go up for any reason, steel and aluminum, you got a lower end sale point, and that's hard on the suppliers. And the suppliers are really kind of at the service of the OEMs. The OEMs will come back and try to negotiate some absorption of the hurt. So we don't really know where that's going to settle. We're hopeful that some deal can be worked out, specifically with respect to USMCA. But we're not jumping back in on autos yet.
Sam, thanks for being here.
Thanks for having me.
Sam LaBell is portfolio manager at Veritas Asset Management.